Welcome to a video that I call the deep dive video, and I always want to explain this right off the bat. Every week I do a number of videos. I do a daily video, I do a weekly video, I do an intermarket analysis video. When I get done with those three main videos, I go through and I look at specifically the daily charts, and I pick out those that aren't necessarily telling us anything right now, but still might be valuable to look at. Hence the name deep dive. We have to look a little bit deeper as to what's going on. There are also some additional charts in this video that are unique only to this video. This is being prepared for Monday, June 24th. I do have a program. It's called the SPX investing program. Pretty much everything I focus on is on the S&P 500. I have a basic course if you're really new to this. I have a very lengthy technical analysis course that I'll be rolling out in July. I have strategies, and I do another class on mental analysis. In addition to that, I have a number of different things that I go through, and I look at possible portfolio ideas that might interest you based on the strategies that are taught. We have a place to be able to have a back and forth of discussions and a lot of other things. I post a lot of additional videos that you don't necessarily see here. If you're interested in that, it's free for the month of June. All you have to do is supply an email address. Then in July, I'll be locking it down. So you'll still need that email address. If you don't like it, you can just unsubscribe. That's fine. There are links about the program in the description below this video and every video that I post. There's also a link which will take you to the SPX investing website, so you can check things out there. The first chart that we look at is the VIX chart, and the VIX is invisible on here. We use this to determine what is the range of the VIX at any given time. In order to do that, I plot a 50-period exponential moving average. Right now, we're coming down into a lower range, and that's usually what we see happen when the market is positive. When we were going down during the great financial crisis, the VIX went up to a higher range. After the COVID plunge, we were also in a higher range. 2022 was difficult for the market, so we were in a higher range. Now that we're coming back down, that tends to be more positive. We don't use this to make decisions. This is just informational to let us know what's going on in the market. Also, I will pull this out from time to time and actually show it. We want to see how fast is the VIX moving. It's a fear gauge. Are we really moving up or are we really moving down? Right now, we're getting pretty much a neutral reading here. How I measure this is using an RSI based on 9 periods. We look for extreme positive or negative readings. Since we're just about a little above the middle, it's not really telling us all that much now. There are some other VIX studies that I do. There's a VIX, and then there's an indicator and an additional way of looking at the VIX called the VVIX, or the volatility of the VIX. And then I do a ratio between the two. If you look down below where I have a moving average plotted, when we're going up, typically this ratio is going down. When we're going down, typically this ratio is going up. Right now we are declining, so that means that there's a more positive environment currently. Then this is one that I'll pull out on an as-needed basis. It's a VIX and then a correlation to the S&P 500. When I make note of this chart is when we get above this dashed line. That's the way the market is saying in another way that it's getting quite nervous, that maybe fear is getting pretty high at this point, and we may not be seeing that in the VIX itself. So sometimes we can get some clues from this chart. Currently, we're well below this dashed line, even though it's going up, but that's really not what I look for. I really look for some kind of an extreme reading on this chart, and we're not getting it right now. The skew index, I was showing this a few times earlier in the week. The VIX is calculated by using at-the-money options. A very similar type of measurement is called the skew index, where it's calculated looking at out-of-the-money options. When we go up into this red area, the market is expecting some kind of a big move. Well, we came up into this red area and we're there for a couple of days, and that's when we shot higher in Monday's session. After that, we started to drop down with the skew index, and we're not getting an extreme reading. If we go back up into this red area, then I will be showing this chart again. Now, some folks like to try to pick this out and say, oh, we're getting a high reading, the market's going to crash, or we're getting a high reading, the market's going to go up. We see a mix of signals along the way. There are times when it marks a top, other times when it marks a bottom, sometimes it also marks a continuation. The last couple of signals that we've had really have been more of a continuation type of thing. But when we did have that big up day, this is when the skew index came down. So that was more or less confirmed by the solid up move. We look at the volatility of bonds, which is called the move index. We also look at the volatility of stocks, which is the VIX. And then at the bottom, I look at the correlation between them. This isn't measuring what they're doing. This is measuring the volatility of each as it relates to each other. They had been showing a pretty strong correlated relationship. So the volatility in the bonds was going up or down as volatility in the stocks was going up and down, pretty much in tandem with each other. We've backed off of that a little bit now as they're getting a little bit disconnected on a volatility basis. And we look at a ratio between the VIX stocks and the move index bonds and do a ratio there. What I pay attention to the most is the red 50-period exponential moving average. You can see when this is going down, often that's when the S&P is going up. When this is going up, that's when the S&P is going down. We had been going down for 2024, which was kind of a contradiction of the market actually going up. Now we seem to be headed more down, and that could be more positive for the market. So this isn't infallible. We just take this in a more general sense of how it's moving. Then I was using this a lot. We want to look at a ratio between risk on, which means people are getting into stocks, especially growth stocks, or risk off, meaning that they're either getting out of the market or they're jumping into more defensive type stocks. And when we're really going up, that's more of a risk on type of a move. When we're going down, that's a risk off move. And for most of 2024, yeah, we've been drifting a little bit lower, but we haven't really been seeing an awful lot of movement. So there hasn't really been any insight that we're getting from this chart. We look at another ratio between the high beta stocks. These are the ones that outperform the market. These are your NVIDIAs and your Apples and your Googles and your Microsofts, the stocks that really move and actually outpace the market on the way up. Unfortunately, they also outpace the market, or underpace, I should. They go down faster than the rest of the market. So it's great to be in them when we're going up. It can be a lot of pain when you're in them and we're going down. And then I look at more low beta stocks, and I do a ratio between the two. When this is going up, that means folks are favoring the high beta stocks. When this is going down, they're getting into the more low beta stocks. And this too has really been chopping around. We were in a range for the first part of 2024. We dropped down, and now we're in another range. So we're not getting an awful lot of insight from this chart. Then this is more for just information. We set a high back in early January 2022 before we went into a pretty negative environment. And then we finally were able to go back and set a new all-time high. And as of Friday's close, we are 13.41% above the previous all-time high. Stockcharts.com has this thing called technical alerts, and these are automatically triggered. They deal with indexes, sectors, and so we can kind of see if it's a more positive or negative thing based on what's happening. We start by reading at the bottom, where first of all, back on Monday, the dollar crossed below 105. That gave stocks some really good support. And we had an update with the NASDAQ. We saw a crossover with the industrial sector. The S&P set an all-time high that day. And then we saw some other signals being carried out here. And then the very last signal that was triggered ended up being in Friday's session. So really how I look at this, because I go through each individual day's alerts in the daily videos. When we see a lot of blue or green, depending on what color you see, that's more positive. When we see a lot of red, that's more negative. Then stockcharts.com also has this way of trying to remove emotion from a chart by giving it a score, a technical score. On a scale of 0 to 100, the higher the score, the better looking the chart, so that we don't have to necessarily look at this and interpret it ourselves. It's trying to give us a more objective type of measurement. What I do is I look at this based on indexes. Now, you can look at this based on stocks or sectors or whatever you want to do, but I look at 5 main indexes. Of course, I look at the S&P 500. We look at the QQQs, which is the NASDAQ 100. We look at the Dow. And we look at the mid caps and the small caps, and then we rank them with the #1 chart coming in first. And coming in first again this week is the QQQs. They're coming in at 94.3. That's fallen a little bit. We had been a bit above the 95 level a week ago, but any score of 90 or above means that this index is really quite strong. Then in second place is the S&P 500 coming in at 91.2. And there's a lot of the Magnificent Seven and large cap growth stocks that are in the S&P, and that's why this index is also doing well. Now, making a bit of a comeback here is the Dow. Now, a week ago, if you watched this video, the Dow came in last place. It had a pretty good up week, and its technical score has improved to 55.8. And we're seeing the mid caps showing an improvement here. They're above 50, but they're still kind of lagging behind. Earlier in 2024, it was the mid caps that for a number of weeks in a row, it came in first place as the best looking index. Right now, it's coming in at 52.4. And then in last place are these poor little old small caps, which are not doing very well, coming in at 18.6. And it's been very frustrating for those of you that are involved in small caps to follow those in 2024. Then I have a series of short-term charts. This is what I call a rainbow. And the reason why it's short-term is we have a 10 period all the way up to a 50 period simple moving average. But I like to look at this chart in total. It goes back into 2019. And we can kind of get a big picture look here at the short-term trend. And we see that the lines are going up and price is still above the lines. So this means that the short-term trend is still positive. Then I have some intermediate term charts, same type of thing here, except we're going from 50 periods up to 100 periods. We're also well above the lines. The lines are going up, so this means the intermediate term trend is still positive. We want to keep an eye on the 50 period moving averages, and I plot both a simple and an exponential moving average here because I'm always asked which one's better, and I go, yes. So I plot them both because some people prefer one over the other. We're kind of far away from this right now. If we start to see a decline and we fall through the 20 period moving averages, then we'll start keeping an eye on the 50 period moving averages. And that same thing is true with the 100 period moving averages. We're still well above them right now, so there's been no need to show these in the videos. Here's another momentum oscillator that gives us extreme positive or negative readings. It's called the Connors RSI, and it really bounces around all over the place from day to day. But we don't see very many extreme positive or negative readings. When we do, then I start showing this in the daily videos. The point and figure chart, we did see a new X drawn in earlier in the week. The S&P spent a brief amount of time above 5,500. It was right at the open, and then we dropped down after that. But when that happened, that was enough to put in a new X. Now, if it's new for that particular day, this X would be green since it happened a few days ago. This X is now black, but we're looking pretty positive here. When we look at all of this, this is how much does an index or a stock or a sector have to move if it's going to the upside, and it doesn't take time into account, just price. And when we're really moving to the upside, then we see a lot of X's. When we're really going to the downside, we see a lot of O's. And this also generates some signals. And we had a signal that was triggered back on May 15th, a double top breakout. And it's when we broke above this previous upward movement of X's here. And so this is still looking quite positive for the time being. Then we use a thing called anchored moving averages, where they're a little bit different than regular moving averages. When you use a regular moving average, you go from the current price and then calculate backwards. With an anchored moving average, you go to a backwards price, and then the anchored moving average actually projects going forward. These are more helpful when we're going down. And since we haven't been going down, I haven't drawn any additional anchored moving averages on here. If we start to see some kind of weakness, I may draw an anchored moving average from here, from this high, maybe going back to this high, just to see if they are offering different levels of support. I also have a couple of longer term anchored moving averages going back to the COVID low, and we're well above all of them right now. We want to know how far above are we from the 200-day simple moving average, and we're about 12.868%. It's kind of hard to see those numbers, maybe 12.88%. Nonetheless, we're well above the 200-day moving average. This is suggesting that the long-term trend is still positive. We want to keep an eye on the S&P 100, which has really been doing well when you compare it to the S&P 500. The 100 are the biggest stocks that make up the S&P 500. We're not really seeing any divergences here right now. They're more going in tandem with each other, but the S&P 100 is outperforming the rest of the S&P. And here's some measurements going from the low that we set back in October of 2023. And as of Friday's close, we're up 24.88% from that low set last October. Bollinger Bands, we did have an extreme positive reading. That you can do a lot of different things with Bollinger Bands. How far are the bands from each other, whether we're above or below the midpoint, what direction are the bands going. One thing that I use is when we close either above or below one of the Bollinger Bands, that's what the percent B indicator measures. We did have one when we were really shooting up, but then the Bollinger Bands themselves are dynamic, so they're continuing to go up, and we came back down inside of the Bollinger Band, so we're no longer getting an extreme reading. When we do hit one of these, it doesn't necessarily signal a reversal, but it might signal some kind of a slowdown will happen, and that's kind of what happened here. The mass index is not generating a signal. We pay attention to this when it goes above the red dashed line and then the blue line, and it's far away from that currently. The Ichimoku cloud, this is a series of moving averages that are placed on current price and then shifted forward. This is heavily used in Forex trading, where I use this as a support or resistance area. And since we're above the cloud and the clouds are green, this is still positive and we're far away from the cloud, so I haven't been showing this. Then there's a thing called a full study that goes in with the Ichimoku cloud, or the same thing, but I use a shorter term version of the chart. When the blue line is above the red line, that's positive. You can see when we were really moving up, that's what happened. We're also seeing the green line going up for the most part, even though it did come down in Friday's session, and we're above both of the clouds. So taken all together, this chart is positive. Then we have another long-term rainbow going from 50 periods up to 250 periods. And the lines are going up, prices above all of the lines in the rainbow, and everything is looking quite positive here. So the long-term trend is still positive and intact. This is a study that kind of comes in and out of the daily videos because it's a little bit longer term. It's a 10-day average of the S&P 500 highs minus the lows. And when we were camped up here, this was suggesting good momentum. Well, then we started to see some weakness back in April into May, and so this started to fall down. It has been improving and it's going back up, but it's not giving us an extreme reading. Now, there's other times, like in 2022, when we would come up to this level and just hit it, and that would mark an overbought situation because we were in a downtrend then, and we wouldn't stay here for very long. So, and we would immediately turn and go in the other direction. So when we see a lot of readings up here that are extreme, that just means that we're in a bull market, which is being confirmed by other charts that we look at. Then we have a long-term oscillator called the Special K. We are above the red line and positive, where the weekly chart still continues to be negative. And we look at a weekly chart of the S&P on top and the German DAX, that's the biggest stock market in the EU, and look at the correlation between the two. Well, there were some problems with the French election and what's France going to do about staying in the EU and blah, blah, all of this stuff. And so Europe was under some pressure a week ago. They were starting to bounce back this past week. So we've seen this correlation between the US stocks and German stocks actually falling off a bit right now. Then some support and resistance levels. This is a 20-period simple moving average of the open, high, low, close. And this creates a little mini rainbow. And we're above all of the lines and the lines are going up. If we fall back, we'll be looking to see if one of these lines provides support. But for right now, we're quite positive. Fibonacci retracement's possible because every time we hit a new all-time high, which we hit this past week, I have to adjust this. And it's kind of interesting where if we do end up seeing some kind of a significant pullback to the 38.2% retracement level, that's just about where we hit some lows here. So the market may be working out some kind of support. Now, we don't know if we're going to come down here, if we're going to still go higher. We just want to watch these things and be prepared in case the situation does turn more negative, and we're already prepared with some charts to watch. Then the broad market, the QQQs, I was showing this a lot when the shorter term moving average based on 20 periods crossed below the 50-period moving average. Well, then we started to cross back above it, and the Qs are above all the plotted moving averages, so there's been no need to show this. We get positive confirmation from other charts. This is the Vixen, and you gotta love that name. This measures the volatility of the NASDAQ 100. I mainly focus on the VIX, which measures the volatility of the S&P 500. Got a lot of crazy data in here with the bar chart. If anything, I tend to look more at the line chart. And we have been coming up just a little bit. The NASDAQ 100 was actually down on the week. We want to keep an eye on the financial sector and specifically more on the banks, just in case something weird starts to happen. And we are dropping off a little bit, dropping below the 50-day moving average with the bank ETF, but the blue line is above the red line, so we're still in a longer-term uptrend. And we want to keep an eye on a little bit more of a subsector here called the regional banking ETF, because Silicon Valley Bank, Republic Bank, New York Community Bank, those are regional banks. And right when we really started to see this fall, that's when Silicon Valley Bank and Republic Bank were having trouble. We were trying to get back and improve here. And then New York Community Bank came out with their news and just kicked this ratio back down. So we compare it, the regional banking ETF to the financial sector, just showing how the regional banks are really underperforming. Then we have the S&P 500 on top, and then a ratio between the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow. And they're seeing a pretty strong correlated relationship right now. So this ratio and the S&P are tending to go in the same direction at the same time. The transports have been a real disappointment. That's the red line, and they continue to decline. The Dow has been holding up a lot better. That's the black line. In a more positive environment, we want to really see the transports even outperforming the Dow, but we just have not been seeing that in 2024. Then we do another ratio comparing the SPY, which is the ETF for the S&P 500, and then doing it on a ratio with world stocks. When this is going up, that just means that the SPY is outperforming, and that's really what we've been seeing for quite a while now. I have a couple of rate of change charts. These are very long-term, and they're based on 250 periods. When these are continuing to go up, that's more positive. Here's another 250 period chart going all the way back to 1980, where we're looking positive for the most part. We've been seeing this really going up since we hit the lows back in October of 2022. I do show a lot of bond charts. This is one chart that I don't show all that much. When folks are worried about inflation, they get into a thing called TIPS. And these are Treasury inflation protected securities. And when they are concerned, that means the TIPS are outperforming 3 to 7 year bonds. When this is going down, that means the 3 to 7 year bonds are outperforming. Well, we've been seeing this going back up as inflation was becoming more of an issue, enough to generate a golden cross here with this ratio. What we want to see is this continue to go down. The reason why I don't show this chart is I also have a TIPS to 7 to 10 year bond ratio chart. And that's more pronounced, where this one's pretty much been going sideways. The 7 to 10 year, it's been gyrating around a bit more. Then we look at the long-term bond ETF, which is in blue, and we look at the S&P 500, which is in red. We look at the long-term correlation. Now, this is the long-term bond based on price. And we're seeing that from a long-term perspective, their correlation is pretty strong. They're usually going up or down together. And also the shorter term 10-period correlation is also getting stronger as well. I have a couple of spread studies down here that I plotted on here, but I don't know if they really help us all that much. We also look at the Qs to the long-term bond ETF and look at the correlation between them, where the Qs are also having a tendency to have a pretty strong correlated relationship with the long-term price of bonds. And then we look at the U.S. 10-year yield on top. We subtract the German 10-year yield. Since U.S. rates are higher, that's what gives us a positive answer. And then for some silly reason, we plot this U.S. dollar index down here, and we see that there's a pretty strong correlation between the top chart, which means interest rates, specifically U.S. and German rates, and then the dollar index, and they're having a little bit of a tendency now to go in the same direction at the same time. Not a real useful chart, but just kind of interesting nonetheless. Sometimes I look at this every day to see if it's really telling us anything, but we want to keep an eye on the dollar, and we want to keep an eye on interest rates, because both of those going up can often put pressure on stocks. Then we're looking at the yield curve, and my goodness, for 2 years now, the yield curves, especially the 10 to the 2, has been inverted. Took us a little bit longer, but the 10 to the 3 month is also inverted. And we're wondering, is it ever going to go back to being normal again? I have some other yield curves plotted here that have gone back to being normal. Some are going back and forth, back and forth. It's the 10 to the 2 year and the 10 to the 3 month that are most important, but we just kind of keep watching this chart now year after year. And then I have a number of things called possible positive scenarios. These were really helpful back in 2022 when we would go down and it looked like we were at least seeing some kind of a short-term bottom. And so I would pull out all these additional charts to suggest that we might see some kind of a bounce here. Well, some of those charts I use in the daily videos still because they can be quite helpful. Other charts that I'm not using currently are what I'm showing in this video. The first one is the percent of stocks in the S&P above their 200-day simple moving average. Now, I have another study that I do show every day, but this is a little bit different than that. We use this like an oscillator when we get to an extreme positive or negative reading. Well, we're not there now. But we are still more positive since we're above 50 here. And that's a little bit more what I focus on with the other 200-period moving average study. Doing that same thing with the S&P, the stocks above their 50-period moving average, we had been turning more negative. We were dropping below 50. Now we're just barely starting to go back above 50. And that's positive. But we're still, well, we're just a little bit above 50 with the mid caps. But we had been seeing some weakness here. And we're looking pretty weak here when we look at those stocks in the small caps that are above their 50-day moving average. That's below 50 as well. And then we track the 2-year yield along with the S&P 500. Sometimes when we see a spike and it starts to come down, that will give short to intermediate term support to the S&P. We pretty much not enough of a spike for the market to really cue off of, so I haven't been showing this chart. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend. I'll clear my throat one more time, and I will talk to you in the next video.